learn with joy.
Hi, hello champions. Good morning. This is your CA Trilok. I am doing good. I hope your preparation is also going well. Many students are requesting me to upload the videos based on the standard costing, marginal costing, and activity-based costing. Today in this video, I'm starting with the topic called the marginal costing. So once I done with the marginal costing, and then I'm going to upload the standard costing. In case of standard costing, my format is slightly variant from the institute study material. So it will take time for me to write handwritten notes. So once I'm done with that, I'm going to upload the standard costing also. Without wasting time, let us get into the topic called the marginal costing. So please understand, in this chapter, it is all about decision making. Decision making regarding the sales. Throughout the chapter, the decisions is going to revolve around the sales. How much sales we need to make to reach the profit zero? How much sales we need to make to get the profit of X amount? How much sales we need to make to get the indifferent situation? How much sales we need to make to get out from the shutdown point? Like that, every concept in this chapter is based on the sales decision. Okay, now when the purpose is decision making, we all know that I already told you in the introduction. When the purpose is decision making, we are going to classify the cost into variable cost and fixed cost. That is the cost classification. Throughout this chapter, we are going to find only variable cost and fixed cost. We will never find the manufacturing, administration, selling, and distribution. So please understand, this manufacturing, administration, selling, and distribution, we are going to classify into two parts: variable cost and fixed cost. All these four cost classification we are going to segregate into variable and fixed. Variable manufacturing cost plus variable administration cost plus variable selling and distribution cost, put together we will call it as the variable cost. Same way we will put together and call it as the fixed cost. First, let us understand what are the topics that we are going to discuss in this chapter. In your syllabus, when it comes to CAinter and CMAinter, what are the concepts that is given in the syllabus? So what is the concepts? Number one, see here, they given CVP analysis, limiting factor, indifference point, shutdown point, marginal costing versus absorption costing. Today in this video, I am going to start with the concept called the CVP analysis, which is also called the basics of marginal costing. CVP analysis stands for cost, volume, profit analysis. So the major discussion in this, look at here. Here it is, CVP analysis is of three variables, that is cost, volume, profit analysis. The major discussion is how the volume is going to impact the cost and how the volume is going to impact the profit. That is the major discussion of this chapter. Are you understanding? So look at here. I am taking one of the example to understand the basics of the marginal costing. So I have taken the selling price 10 rupees, variable cost per unit 6 rupees, fixed cost 200 rupees, unit sold 100, and these are the requirements. These are the basics of the marginal costing. Preparation of income statement, PV ratio, VC ratio, all these are the basics of marginal costing. Let us study one by one. First of all, income statement. So please understand, you would have already come across the cost sheet. Cost sheet is the format which is based on the classification of manufacturing, administration, selling, and distribution. There the purpose is stock valuation and profit calculation, so that we can say that classification. But now the purpose is decision making. We are going to classify the cost into variable cost and fixed cost. On that basis, we given the format of the income statement in the marginal costing. What is the format of income statement means? First we'll take the sales. From the sales we'll reduce the variable cost. We given the name called the contribution. Look at this. I'm starting with the income statement. And one more thing for your information, whatever the material I am presenting here, I am going to add on the description of this video. You can download the material. Everything is handwritten notes. And I am going to solve few typical questions based on this concept. Okay, now, initially we have taken sales minus variable cost. We given the name called the contribution. Now what we need to understand is why they given the name called as contribution. Why they are calling it as a contribution? Please understand. They are calling it as a contribution because it contributes. Don't laugh. It is a real meaning. Of that. They given the name contribution because it contributes. Initially, towards what it contribute means towards fixed cost it will contribute. Once the fixed cost is recovered, later it will contribute towards the profit. Let us elaborate this. Let us elaborate this. In our example, the selling price is 10 rupees and variable cost is 6 rupees. Please understand, the selling price is 10 rupees and the variable cost is 6 rupees. I am giving the product. I am giving this product at the rate of 10 rupees. I am getting 10 rupees. This entire 10 rupees is not my profit. To get this 10 rupees, specific cost, which is called as variable cost, incurred for this product is 6 rupees. I am getting 10 rupees. From that 10 rupees, I am going to exclude the 6 rupees. The balance left out in my hand is 4 rupees. Using this 4 rupees, initially we will try to recover the fixed cost. From the 10 rupees, what we excluded, 6 rupees is a variable cost. Now we need to recover the fixed cost also. So by reducing the variable cost, each unit is giving 4 rupees. Using this 4 rupees, we will try to recover the fixed cost. Whichever the units is contributing towards fixed cost, it is called as break even. Okay. The units which help to recover the fixed cost is called as the break even point. The units which makes the profit will be calling it as the margin of safety. In our example, each unit is giving the contribution of 4 rupees. What is the total fixed cost? 200 rupees. The total fixed cost is 200 rupees. So how many units we need to sell to recover the fixed cost? 200 divided by 4 rupees per unit. 200 divided by 4, 50 units. What is the total number of units that we are selling? 100. Out of 100, 50 units are break-even point and balance 50 units are called the margin of safety. Are you understanding? Okay, now, so that they call it as the contribution. They given the name contribution because it contribute towards the fixed cost and then contribute towards the profit. The units which contribute towards fixed cost is called break-even sales and the units which contribute towards profit is called the margin of safety. Now, it's time to understand what is the purpose of this income statement. Why is they given the income statement like this and how it will be helpful. Let us understand that. Look at here. I am taking these units at 100 units. I am taking this calculation at 100 units. Now I am going to take the same calculation for 200 units. Let me take the calculation for the 200 units. 200 into 10, 2000 rupees. 200 into 6, 1200 rupees. If you reduce this, we will be getting 800 rupees from that fixed cost. When the number of units increases from 100 to 200 units, will the fixed cost changes? Absolutely no. So I am going to take the same fixed cost 200 rupees. So the profit what we are getting is 600 rupees. Here what you need to understand is that the difference in the contribution is rupees 400 increase. That the contribution has been increased by 400 rupees. And if you observe properly, there is an increase in profit also 400 rupees. So what I need to conclude here, what I mean to conclude here is change in contribution is always equal to change in profit. Change in contribution is equal to change in profit. If your contribution increased by 10 rupees, your profit also increased by 10 rupees because in between those two, fixed cost is constant. If your profit decreased by 50 rupees, if your contribution decreased by 50 rupees, your profit also decreased by 50 rupees because in between those two, fixed cost is constant. So simply I can make one statement here, change in contribution is always equal to change in profit because of constant of the fixed cost. The purpose of this income statement is we can easily calculate change in profit with respect to change in sales. We can easily calculate change in profit with respect to change in sales. So how we can do that? We all know that each unit is giving contribution of 4 rupees. If the sales increase by 10 units, each unit is giving 4 rupees, 10 units into 4 rupees, 40 rupees is the contribution increase. If contribution increased by 40 rupees, your profit also increased by 40 rupees. So simply what I mean to say, to calculate change in profit, you calculate the change in contribution, which is both are equal. So what I mean to say, if 100 units increase, 100 into 4, 400 rupees is the profit increase. If 50 units decrease, 50 into 4, 200 rupees is the profit decrease. That is the main purpose of this income statement. Have you understand this? Okay, now look at here. The above income statement helps to calculate change in profit with respect to change in sales. Change in contribution equal to change in profit because between contribution and profit fixed cost is cost. So this is about the income statement. It is the time to learn PV ratio, profit volume ratio. I know that I'm going a little bit fast. I'm in the assumption that the two people already took the coaching and you're watching my video for the revision purpose, so that I'm a little bit fast only because I don't want to consume more time to give them more knowledge. Within short time, my target is to give more knowledge within short time. If you want to adjust the speed, you can slow down the speed. If you're not able to catch my words, you can slow down the speed. Okay, now look at here. Profit volume ratio, PVR stands for profit volume ratio. One more name for this PV ratio is contribution sales ratio. That is the real name of this ratio, contribution sales ratio. To understand this, first we need to know gross profit ratio. What is the formula for gross profit ratio? Gross profit divided by sales into 100. Net profit ratio, net profit divided by sales into 100. Same way, contribution sales ratio, contribution divided by sales into 100. Contribution divided by sales into 100. Look at here. Contribution divided by sales into 100. Are you understanding? All of you? See, gross profit, if you want to calculate gross profit, sales into gross profit ratio will get the gross profit. Net profit, sales into net profit ratio will get the net profit. Same way, if you want to calculate the contribution, sales into contribution sales ratio will get the contribution. But here what you need to understand, is to calculate the PV ratio, total I am giving you 4 formulas. Using these 4 formulas, we can calculate the PV ratio. All the ratios will give the same answer. Are you understanding? All of you. And one more thing, this PV ratio is just a percentage of contribution. PV ratio is just a percentage of contribution on sales. 20% means out of sales, 20% is the contribution. 30% means out of sales, 30% is the contribution. Understand? Now look at here. PV ratio stands for profit volume ratio. It is also called as contribution sales ratio. The formula is contribution divided by sales, contribution per unit divided by selling price, change in contribution divided by change in sales, change in profit divided by change in sales. You need to understand one small point here. Which formula has to be used depends upon the information provided in the question. If they given you the totals, take contribution divided by sales. If they given you the per unit, take contribution per unit divided by selling price. If they given you comparison between two periods, then change in contribution divided by change in sales or change in profit divided by change in sales, because we all know that change in contribution is equal to change in profit. Are you understanding? Look at here. I took the same example, whichever we done in the last previous thing, income statement. According to the income statement, contribution is 400 rupees, sales is 1000 rupees. 400 divided by 1000 into 100, 40% per unit. 4 rupees divided by 10 rupees, 40%. When it comes to change in contribution, look at here. What is the change in contribution? 400 rupees. What is the change in sales? 1000. So 400 divided by 1000 into 100. 400 divided by 1000 into 100, 40%. Same way, change in profit divided by change in sales into 100. 400 divided by 1000 into 100, 40%. Have you understand this? So these are the ratios. These are the different formulas to calculate the PV ratio. Here we need to understand one more thing. Assumption of PV ratio. PV ratio is constant at all the different level of sales. Please understand, this is a unique feature. This is a unique feature of the PV ratio. Let me take an example. Suppose if you want to calculate net profit ratio in this scenario, what is the formula? Net profit ratio equal to net profit divided by sales into 100. Net profit is 200 rupees, sales is 1000 into 100. You will be getting 20%. Here 600 divided by 2000 into 100. You will be getting 30%. See, net profit ratio is changing. When it comes to contribution sales ratio, contribution 400 divided by 1000 into 100, which equals to 40%. Here it is 800 divided by 2000 into 100, which equals to 40%. If you observe, contribution sales ratio is same. Very important. PV ratio is constant irrespective of the sales. By changing the sales, PV ratio is not going to change. But when there is a change in selling price, or variable cost per unit, PV ratio automatically changes. So what you need to remember is PV ratio is constant. As how the fixed cost is constant, same way PV ratio is also constant. But subject to condition is when there is a change in selling price and variable cost per unit, automatically PV ratio changes. Look at here. PV ratio is constant at different sales level, subject to selling price and variable cost should be constant. If selling price or variable cost per unit changes means or selling price or variable cost per unit changes means automatically PV ratio also changes. All of you clear on this point? Understanding? Next. Variable cost ratio. VCR stands for variable cost ratio. That is very simple. Variable cost divided by sales into 100 and variable cost per unit divided by selling price. Here I am giving you one equation, very important equation, very important equation. Based on this, there are many questions in the examination. Based on this, there are many questions in the examination. PVR plus VCR equal to 100%. PVR plus VCR equal to 100%. Look at here. I given the clear cut derivation also. When it comes to PVR, contribution divided by sales, VCR, variable cost divided by sales. If you make a sales common, contribution plus variable cost, contribution plus, see, normally sales minus variable cost equal to contribution. Now sales equal to contribution plus variable cost. So that we take a sales divided by sales, which is 100%. Why it is so important? They'll give you the information which support the VCR. But in the question, they'll give you the PVR. PVR 30%. Then how much is the VCR? 70%. If PVR is 40%, how much is VCR? 60%. If VCR is 80%, how much is PVR? 20%. Are you understanding? Are you understanding? This equation is very important. Very important. Very important. PVR plus VCR equal to 100%. Clear? Okay. So by this we done with the VCR. Next. Let us start with break-even sales. See, many people, whenever I ask the question in the classroom, what is the break-even point mean? They used to say no profit, no loss. But they don't know what is break-even point. Please understand, break-even point is one of the sales. Break-even point is one of the sales. What is the importance of that sales? At that sales, profit is 0. What is break-even point? Break-even point is nothing but sales. The sales which makes the profit 0. Are you understanding? Are you understanding? So, break-even point means the sales which makes the profit 0. How to calculate that? See, we can calculate the sales. When I say break-even sales, we can calculate in units as well as in rupees. In units, formula is fixed cost divided by contribution per unit. In rupees, formula is fixed cost divided by PV ratio. One more formula is break-even sales into selling price. Break-even sales into selling price. And one more thing you need to remember, break-even point is also constant. Please understand, break-even point is also constant. Let us understand this. Look at here. Just now I told you. See here. Break-even sales equal to fixed cost divided by PVR. See, fixed cost is constant. PVR is constant. Just now we discussed PVR is constant. When there is a change in selling price, variable cost, then only it changes. Otherwise, break-even point equal to fixed cost divided by PVR. Fixed cost is constant. PVR is constant. So obviously, break-even point is also constant. But the subjective condition is selling price, variable cost per unit, and fixed cost. This is additional condition for the break-even point. Fixed cost is the additional condition for the break-even point. Fixed cost also should be constant. Selling price should be constant, variable cost per unit should be constant, and fixed cost also should be constant for the break-even point. It is the sales which recover the fixed cost. So that we are taking fixed cost divided by contribution per unit. In our example, fixed cost is 200 rupees. To recover the 200 rupees, how many units to be sold means 200 divided by 4, 50 units. All of you clear? Understanding? Okay, now see here. It is a sales at where profit is 0. The sales which helps to recover the fixed cost. Formula is this, and here I given the assumption. Break-even point is constant at different level, different sales level, subject to selling price, variable cost, fixed cost should be constant. It is the time to learn the types of break-even sales. There are two types of break-even sales. Generally, we discuss normal break-even sales. Just now, what we discussed is normal break-even sales. Apart from that, there is two more models: cash break-even point and multi-product break-even point. Cash break-even point and multi-product break-even point. Look at the cash break-even point. See, cash break-even point equal to cash fixed cost divided by contribution per unit or PV ratio. If you want in units, divide by contribution per unit. If you want in rupees, divide by PV ratio. It's a universal law. All the techniques in the marginal costing will give you in units if you divide with contribution per unit. If it will give you in rupees if you divide with PV ratio. Here I am taking cash fixed cost. What you need to understand is generally the fixed cost can be classified into two categories: cash fixed cost, non-cash fixed cost. Cash fixed cost means rent, salaries paid, all these things comes under the cash fixed cost. Non-cash fixed cost means depreciation, amortization, all these things comes under the non-cash fixed cost. To calculate the cash break-even point, we have to take the cash fixed cost divided by contribution per unit or cash fixed cost divided by PV ratio. And one more point is at cash fixed cost, at cash break-even point, that the profit is 0 means absolutely no. The company will be having loss. that loss is exactly equal to non-cash fixed cost. Why? Because cash break-even point gives the units which recover only cash fixed cost. Yet to recover the non-cash fixed cost, that non-cash fixed cost will be reflecting as a loss when you calculate the profit at the cash break-even point. Okay, look at here. At cash break-even point, profit is not equal to zero. Profit is not equal to zero. The loss is exactly equal to non-cash fixed cost. Clear? Understanding? It is time to understand the multi-product break-even point. Let us understand what is multi-product break-even point. Look at here. I am taking the example of product A and product B. And I took the selling price as 10 rupees, 15 rupees, variable cost 6 rupees, 10 rupees, and the contribution per unit is 4 rupees and 5 rupees. The total fixed cost is 21,000. Here the point which we need to understand is the total fixed cost incurred is 21,000 rupees towards product A and product B. Now the question mark is the 21,000 rupees to be recovered by selling how many units of A and how many units of B. Here it is called the multi-product break-even point. Multi-product break-even point. Very important thing is first we need to assess what is the sales mix proportion of the A and B. What is the sales mix proportion? As I took the example 1:2. 1:2 is the sales mix proportion. Now what we need to do, see the confusing thing is here we have the contribution per unit 4 rupees, 5 rupees. 21 lakh should be divided by 4 or 5 means we have to take the average. What average? Weighted average. Weighted average contribution per unit. We will be calling it as weighted average contribution per unit. Look at here. I shown the calculation. Weighted average contribution per unit equal to 1. Weight is 1. 4 rupees is the contribution per unit. 2 and 5 rupees is the contribution per unit. 1 into 4 plus 2 into 5 divided by 3, which comes to 4.666666. That is the weighted average contribution per unit. So the fixed cost is 21,000. Fixed cost is 21,000 divided by weighted average contribution per unit. We'll be getting 4,500 units. This 4,500 units is having A as well as B. That we need to divide in the proportion of 1:2. If we divide in the proportion of 1:2, it comes to 1,500 units of A and 3,000 units of B. So what is the meaning of this? What is the meaning of this? The company has to sell. The company has to sell 1,500 units of A and 3,000 units of B so that it can reach the break-even point. Now management will give the targets. The management will give the targets to the respective sales managers. Sales manager of A will be given the target of 1,500 units and sales manager of B, product B, will given the target of 3,000 units. Have you understand the multi-product break-even point? These are the 3 different types of break-even point: normal break-even point, or total break-even point, cash break-even point, and then multi-product break-even point. So by this we are done with the break-even point. And as I told you, break-even point is constant. As how the fixed cost is constant, break-even point is also constant at different level of sales. What does it mean? When the sales keep on increases, the break-even point is not going to increase. Subject to condition is selling price, variable cost per unit, and fixed cost should be constant. When sales changes, BEP and PVR will not change. But when the sale price changes, BEP and PVR both will change. Clear? Understood? Okay? Now, margin of safety. I already told you the units which generate the profit. The units which generate the profit is called the margin of safety, which is also called the profit generating sales. Which is also called the profit generating sales. Or this is also called that is the sales above the break-even sales. Sales above the break-even sales. Once we touch the break-even point. See, look at here. I can give you the example. Break-even point is 50 units. At 50 units, profit is 0. At 50 units, profit is 0. 51st unit will give the profit. Up to 50, they are recovering the fixed cost. 51st unit will give the profit of 4 rupees in our example. 52nd unit 8 rupees. 53rd unit 12 rupees. 54th unit 54th unit 16 rupees. Like that the profit will be keep on increasing. So sales above the break-even sales is called the margin of safety, which is also called the profit generating sales. So how to calculate this? Simple. Profit divided by contribution per unit. Profit divided by contribution per unit. Look at here. Profit divided by contribution per unit. Oh, I given the wrong arrow mark. This is the formula for the rupees. Okay. Look at here. When it comes to margin of safety, profit divided by contribution per unit. When it comes to rupees, margin of safety unit divided by selling price, or profit divided by PV ratio. Profit divided by PV ratio. Are you understanding? This is the formulas to calculate the margin of safety. When it comes to margin of safety, there is no constant nature. Profit will be keep changing. Even one factor changes, profit will be keep changing. If the profit changes, automatically margin of safety also changes. All of you clear? Understanding? Okay. Now there is no constant nature, and this is the very important equation. Very important equation. That is break-even sales plus margin of safety equal to 100%. That is the total sales. Break-even sales and margin of safety, if you add together, that is called the total sales. Why? Because in the question they'll give the information which support the break-even sales, but they'll give you margin of safety 40%. If margin of safety is 40%, then break-even sales is 60%. If break-even sales is 30%, then margin of safety is 70%. If margin of safety is 75%, then break-even sales is 25%. This equation, so you need to remember two equations: PVR plus VCR equal to 100%, break-even sales plus margin of safety equal to 100%. Based on these two equations only, there are many questions, many questions from the CVP analysis. Clear? Next, profit calculation. So there are different formulas to calculate the profit: sales minus cost. One more formula is contribution minus fixed cost. One more formula is margin of safety units into contribution per unit, and margin of safety rupees into PV ratio. These are not the two different formulas. Please understand, margin of safety units equal to profit divided by contribution per unit. So profit equal to margin of safety units into contribution per unit. I am writing the same formula here. Next, margin of safety rupees. We all know that profit divided by PV ratio. So profit equal to margin of safety rupees into PVR. Are you understanding? So these are the different formulas which helps to calculate the profit. At last, sales at desired profit. This is one more very important formula. Sales at desired profit. They'll always try to link with this. They'll ask you sales. What is the sales that need to be made to achieve the X profit? Or what is the profit that the company can make at the sales of X amount? So they'll always try to link the sales with the profit or profit with the sales. So simple formula: if you want to calculate sales in units, fixed cost plus profit divided by contribution per unit. If you want to calculate the same sales in rupees, fixed cost plus profit divided by PV ratio. Very important formula. Sales in units. If they ask you the requirement sales in units, fixed cost plus profit divided by contribution per unit. This is universal law. Divided by contribution per unit to get the unit. Divided by PV ratio to get the rupees. Not only for this formula, all the formulas. Break-even sales, margin of safety, sales at desired profit, indifference point, shutdown point, all these things. Even for the profit calculation, margin of safety units into contribution per unit, margin of safety rupees into PV ratio. Have you understand this? All of you. Let me start few questions. Let me solve few questions which are typical, which is not able to manage by yourself, so that I'm helping you on these questions. Okay, look at here. Okay, look at this question. Question is very simple, but you need to understand concept behind that. Now look at here. A company has PV ratio of 40%. Compute by what percentage must sales be increased to offset 20% reduction in selling price. So they given the PV ratio. PVR equal to 40%. What they given is PV ratio. Now what they are asking, what percentage sales should be increased? What percentage sales should be increased to offset the reduction of selling price? To offset the reduction of selling price by 20%. This is the question. So they are interlinking sales and selling price. They are interlinking sales and selling price. So what they are asking, selling price is decreasing. Selling price is decreasing by 20%. When the selling price decreases by 20%, automatically sales decreases. If sales decreases, automatically profit decreases. Now what they are asking? They are asking to offset. They are offset in the sense what? The reduction in selling price should offset by increasing the sale units. Now they are asking, it is reduced by 20%. Selling price is reduced by 20%. What is the percentage of increase in sale units? Simple. I'll tell you. Look at here. Sales equal to units into price. Sales equal to units into selling price. Selling price decreases by 20%. It will have the negative impact on the sales. Means sales will be decreased. Now what they are asking, to offset this reduction, what should be the increase in sales volume? Sales volume or sales units. What should be the, see, they are asking percentage question. Here they given percentage. 20% is the decrease. Now they are asking what should be the increase percentage? What should be the increase in units percentage, so that it can offset each other? It can offset in the sense reduction in sale price will offset by increase in the sale units. so that the sales will remain same, so that the sales will remain same, so that the profit will remain same. Okay, now look at here. Now look at here. I hope everyone understand the question. I hope everyone understand the question. I am giving you the solution. First, I taken the present. Just look at the present. Don't look at revise. Look at the present. PV ratio 40%, therefore V share is 60%. I already told you PV ratio 40%, V share is 60%. I took the example. Sale units as 1000, selling price, let sale units be 1000 and selling price is 100. Here they didn't mention any information. I am taking the example. Sale unit 1000, selling price is 100. If selling price is 100, variable cost is 60 and contribution per unit is 40. This is the present situation. And the total contribution is 1000 units into 40, 40,000. This is the present scenario. When it comes to revised, what is going to happen? Selling price decreased by 20%. Selling price decreased by 20%. Then 100 will become how much? 80. There is no change in the variable cost. 80. Variable cost is not getting changed. 60. Contribution per unit is 20. And one more thing. PV ratio they given 40%. Will it be constant by changing the selling price? Means absolutely no. Selling price is changing, means PV ratio also changes. PV ratio is constant when the sales is changing. When the sales is changing, PV ratio is constant. But here sales is not getting changed. What is changing? Selling price is getting changed. Are you understand? Selling price is 80, variable cost per unit is 60, contribution per unit is 20. Now I calculate the PV ratio. PV ratio is 25%. Earlier it is 40%. Now the PV ratio is 25%. Now look at here. Let sale units be X because we don't know how many units to be increased. In the revised scenario, see in the present scenario I took 1000. Now the 1000 will be increased to offset the reduction in selling price. How much it increased we don't know. So that I am taking it as X. X into contribution per unit 20x. Now to when the reduction in selling price, offset by increasing the sales. When the reduction in selling price offset by increasing the sales, both will become equal. That means sales will remain same. If the sales remain same, contribution also will remain same. If sales remains same, contribution also remains same. So contribution is 20x in the reverse scenario. In the present scenario, 40,000. I will make both equal. 20x equal to 40,000. So x equal to 2,000 units. So in this scenario, how many units the company has to sell? 1,000 units. To offset the 20% reduction in selling price, the company has to increase the sale units by 1,000. Increase the sale units by 1,000 from 1,000 to 1,000. Means totally 2,000. Have you understand this? Look at here. Increase in sale units from 1,000 it increases to 2,000. What is the percentage increase? 1,000 units. Sorry, 1,000 percentage. What is the increase in sales rupees? 2,000 units into 80, 16,000 minus 1 lakh. 1,000 into 100, 1 lakh. So divided by 1 lakh into 100, 60%. So increase in sale units is 100%. Increase in sales rupees is 60%. Increase in sales rupees is 60%. Increase in sales units is 100%. Have you understand this? Very, very important question may come in the examination. So what we need to remember is what is the present and what is the revise. Why I am taking present and revise? Because the PV ratio changes. By changing the selling price, they mentioned that selling price will decrease by 20%. If selling price decrease by 20%, automatically PV ratio also changes. Are you understanding? PV ratio 40%, V share is 60%. Accordingly, I take the present scenario. Then I take the revised scenario. Selling price decreased by 20%. So 100 I take it as 80. Variable cost will remain same 60. Then how much is contribution per unit? 20. 80 minus 60, 20. So 20 divided by 80, 25% is the PV ratio. And I took the sale units as X because we don't know the sale units. How much it increased we don't know. So that I took it as X. And we know the contribution per unit 20. 20x equal to 40,000. Then X I calculated 2,000 units. What is the increase in units? 100%. Same way calculate the rupees. Have you understand this? Okay, next. Question number 10. This question is one of the application oriented and it is a question based on the opportunity cost. Listen to me careful. First you understand the question. Look at the question. A company can make any one of the three products. This wording makes sense. Any one. The company can produce only any one product out of three products. What are the three products? X, Y, Z in a year. It can exercise this option only at the beginning of each year. So what they mean to say, they have the option to produce three products X, Y, Z, but they can produce only one product. That option can be adopted at the beginning of the year. Once they adopt it, they cannot change the option. Okay, now look at here. Relevant information about the products for the next year is given below. They given X, Y, Z. They given selling price. They give a selling price, variable cost, market demand, production capacity, fixed cost. Let us understand these 2 points first. Market demand, production capacity. Look at the product X. Look at the product, only product X. If they decided to product X, if they decided to produce and sell product X, what is the demand in the market? 3000. What is the production capacity? 2000. So how many units they can supply? 2000. Demand might be 3000, but capacity is only 2000. They can supply only 2000. Look at the product Y. Look at the product Y. Demand is 2000, but the capacity is 3000. But demand is only 2000. Just because we have the capacity, it doesn't mean that we have to produce the all the we have to make the production according to the capacity available. We will always produce according to the demand. We will always produce according to the demand. Demand is 2000. We will produce only 2000. So simply I can tell you, out of these two, whichever is lower. Out of these two, whichever is lower. So the production of X 2000, production of Y 2000, production of Z 900. And they given the fixed cost 30,000. What they are asking? Compute the opportunity cost of each of the product. Opportunity cost. First of all, what is opportunity cost? Benefit foregone by choosing the alternative option. Benefit lost. Benefit lost by choosing the alternative option. Being a CA, we have 2 options. Either you can go for practice or you can go for the employment. Can we make both? Absolutely no. If you are going for the employment, you are losing the income from practice, which is the opportunity cost. If you are going for the practice, you are losing the income from the employment, which is again opportunity cost. So benefit lost by choosing the alternative option. Are you understanding? Here, they have the opportunity to select only one product, either X or Y or Z. Are you understanding? Now look at here. Calculation of opportunity cost of each product. The production can be, either it can be 2000 of X, or it can be 2000 of Y, or it can be 900 of Z. See, this is the R condition. This is the R condition. They cannot produce all the 3. They can produce only one product. They clearly stated in the question. Clearly stated in the question, they can produce only one product. So either they can produce X or Y or Z. So contribution per unit, we already calculated. They given in the question. Look at here. They given the question, based on that we calculate the contribution per unit, 4 rupees, 3 rupees, 5 rupees. Total contribution is 8,000, 6,000, 4,500. Now the opportunity cost of X, when it comes to understand properly. The contribution is 8,000 rupees for the X. Let it be. If you produce X, if you decide to produce X, we cannot produce Y, we cannot produce Z. But the problem here is, if you don't produce X, either you can produce Y or you can produce Z, but you cannot produce both again, because Y and Z, these are 2 different products. You cannot produce 2 products. You can produce only one product. If you don't produce X, or else I can mention like this: because of producing X, we are not able to produce Y and Z. But if you don't produce X, either you can produce Y or you can produce Z. So look at the Y and Z. The contribution of Y is 6,000. The contribution of Z is 4,500. If you don't produce X, what is the next option that you will choose? Y or Z? Absolutely Y. Absolutely Y. Because Y is giving more contribution compared to Z. Are you understanding? Same way. When you don't produce Y, if you don't produce Y, then what are the options available? X and Z. Out of these 2, which you will choose? Absolutely X. Because X is having 8,000. So opportunity cost is 8,000. When it comes to Z, if you sacrifice Z, then you have the option of X and Y, which is giving more contribution, X. So we go for 8,000 the opportunity cost. So by not producing respective product, we are losing the contribution of alternative single product, not double products. So accordingly, whichever having the more contribution, that is taken as the opportunity cost. I clearly mentioned the notes. Regarding these points. Okay, next. This is the question based on the multi-product break-even point. Look at this question. MK Limited manufactures and sells a single product X, whose selling price is 40 and variable cost is 16 rupees. So obviously the contribution per unit equal to 24. And again, if the fixed cost of this year is 4,80,000 and annual sales are 60% marginal safety, calculate the rate of net return on sales assuming income tax level of 40%. So let us understand. See, they given the fixed cost. And marginal safety percentage, and they are asking net return. What do you mean by net return? PAT on sales, or net profit ratio. So how to calculate this? Simple. What we'll do? We know the fixed cost. We know the marginal safety. Look at here. First, we need to know PV ratio. Selling price 40, variable per unit 16 rupees. Using that, we are calculating PV ratio. I'm actually sorry. This is contribution per unit. PVR equal to contribution per unit divided by selling price. I told you already. Whenever it comes to PV ratio, we have four formulas. We have discussed four formulas: contribution divided by sales, contribution per unit divided by selling price, changing contribution divided by change in sales, changing profit divided by change in sales. Based on the situation, we have to pick the formula. If the value is in totals, first one, contribution divided by sales. If the value is in per unit, contribution per unit divided by selling price. If there is a comparison, changing contribution divided by change in sales or changing profit divided by change in sales. I'll give you two more formulas later on. As of now, let me complete this question. PVR equal to contribution per unit divided by selling price, 16 divided by 40%. Fixed cost is 4,80,000. Marginal safety 60%. So break-even sales is 40%. Break-even sales is 40%. First we'll calculate the break-even sales because they give the fixed cost. Because they give the fixed cost, first we'll calculate the break-even sales. So fixed cost divided by PV ratio 12 lakhs is the break-even sales. If 12 lakhs is break-even sales percentage is 40%. So 12 lakhs divided by 40%, we'll get the total sales 30 lakhs. If total sales is 30 lakhs, first we'll calculate the profit. How to calculate profit? Simple. Understand. Sales is 30 lakhs. Sales is 30 lakhs into 60%. We'll get, see, 60% is margin of safety. 60% is margin of safety. 30 lakhs into margin of safety, we'll get the 30 lakhs. Sales into margin of safety, we'll get the margin of safety sales. Margin of safety into PV ratio will get the profit. Fourth formula, profit equal to margin of safety rupees into PVR. So 40% is PVR, 60% is marginal safety. Total is 30 lakhs. Total sales into marginal safety percentage will get marginal safety sales. Marginal safety sales into PV ratio will get the profit 7,20,000. Now we know the profit 7,20,000 and here one more point, they given the tax rate. What is the tax rate given? Income tax rate is 40%. Income tax rate is 40%. Let me write that. 1 minus 40%, which equals to just a second, I'm opening the calculator. Okay, let me finish this. Four lakh 32,000. So 4,32,000 divided by 30 lakhs. 14.4%. 14.4% net return on sales. Okay, next. And then they given for the next year, it is proposed to add another product line Y. As of now, we are having product X. Look at here. As of now, we are having product X. Now they plan to add product line Y. Whose selling price is? Whose selling price is? Whose selling price is 10 rupees and variable cost is, whose selling price is 50 rupees and variable cost is 10 rupees. Total fixed cost comes to 6,66,600. Sales mix of X and Y is 7:3. Determine what level of sales next year would MK break even. So they're asking to calculate the break even point. How to calculate break even point? Fixed cost divided by average contribution per unit. First calculate the average contribution per unit. Look at here. We taken the contribution per unit 2440, 7:3. Average contribution per unit is 28.8. So using that, first we calculate the break-even point units 23,145.80, and we are bifurcating between X and Y. We need to see 23,145.80 is the total break-even sales. Total break-even sales that has to be bifurcated between X and Y in the proportion of 7:3. If you divide between that, 16,202, 6,944. So these are the some typical questions. So again, when I'm doing the indifference point, shutdown point, all these concepts, I'm going to add on few more questions. Okay. As I told you, whatever doubt that you are having, you can mention in the comment section, or else you can contact me personally. I already given you my Telegram channel number 9071068553. This is my Telegram channel number. You can add into the group and you can write the queries in the Telegram channel. Are you understanding? And one more thing, please subscribe my channel. Many people are watching the videos, but they are not subscribing the channel. Please subscribe the channel and like the channel. So sorry, like the video if you really feel this content is so helpful for your preparation. Here my target is very simple. Just I am trying to reduce your preparation time. Whatever doubt that you have before getting into the topic, see, just by watching this maybe approximately 45 minutes of video, you'll be getting clear picture of the CVP analysis. It helps to solve all the questions. Here I told you what are the constant, what I mean. I give you the subjective conditions of all the techniques, which is very important. Okay, please subscribe and like and share the videos to the people who are in the need. Thank you so much. We'll meet up in the next video.